Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video is going to cover Chapter 2, Gross Income and Exclusions from Income Tax Fundamentals 2025, 43rd edition. So by the end of this chapter, you should be able to apply the definition of gross income, describe salaries and wages, income reporting, and inclusion in gross income, explain the general tax treatment of health insurance, determine when meals and lodging may be excluded from taxable income, identify the common employee fringe benefit income exclusions, determine when prizes and awards are included in income. So for those who go to game shows or bingo and things of that nature, Uncle Sam has rules around whether or not that will be considered taxable. We'll calculate the taxable and non-taxable portion of annuity payments, describe the tax treatment of life insurance proceeds, identify the tax treatment of interest income, identify the tax treatment of dividend income, identify the general rules for the tax treatment of gifts and inheritances, describe the elements of scholarship income that are excluded from tax. So just because you receive a scholarship from a college, it does not necessarily mean that all of it is excluded. There are some requirements. There are some qualified educational expenses and some that are not qualified. We would describe the tax treatment of alimony and child support, explain the tax implications of using educational savings vehicles, describe the tax treatment of unemployment compensation, apply the rules governing the inclusion of Social Security benefits and gross income, distinguish between the different rules for married taxpayers residing in community property states when they file separate returns, and lastly, will describe the inclusion and exclusion of the cancellation of debt income. So as we move on with this chapter, we know that in chapter 1, we learned about the individual income taxation formula. We start off with gross income. We subtract any adjustments. We get our adjusted gross income. We subtract the greater of our itemized deductions or our standard deduction to get us to our taxable income. And from there, we either use the tax rate or the tax table to determine the tax liability. We factor in the various credits. And from there, we ultimately determine whether or not the taxpayer has a balance due or if they are entitled to a refund. So in this chapter, we start off with the definition of gross income. Gross income is basically the starting point for determining taxpayers' tax liability. So the tax code, there's not necessarily a definition per se, but the tax code essentially defines gross income as all income from whatever source derived. So that's a very broad definition. Reason being, Uncle Sam says, hey, if you are a citizen of the United States of America, it doesn't matter if you earn income internationally, whatever source derived. That means any income you earn needs to be reported for tax purposes. This means all sources of income are included. Here's a key thing: unless it is specifically excluded. So unless there is a specific provision in the tax law that says this type of income, either in whole or in part, is excluded, Uncle Sam basically says you need to report it. So non-cash items are included at fair market value. Barter transactions are includable. So for example, I'm a CPA. I do taxes and bookkeeping. My mechanic, if let's say he has to work on my car and he needs his taxes done, we can barter. Let's say the value of the services are $500. Even though we didn't exchange cash, the fair value of me preparing his tax returns and him fixing the car is $500. Uncle Sam says, hey, that needs to be included in income as well. So I want you to realize that it's not just cash items, but it's also when you barter and exchange services. That also needs to be included. On the next two slides, we'll look at a partial list of inclusions and exclusions, and they essentially give a general idea of the different types of income that'll fit into these categories. So some inclusions in income, the partial list, this includes annuities, awards, back pay, bonuses, business income. As we know, for a self-employed individual, that would be on Schedule C. Cash income, clergy fees, commissions, death benefits, debts that are forgiven. So We live in this day and age where a lot of people, they have credit card debt, and sometimes they're so happy to get it written off. But in the event that, let's say you had a credit card debt for $10,000, and it went to collections and they wrote it off for, let's say, $5,000, you are going to expect to receive a 1099-C in the mail, and that $5,000 that was written off, Uncle Sam says, hey, you're going to include that amount in income. I guess their logic behind it is that maybe you fell on hard times, but if you had the money, you would have paid off the debt. So therefore, you need to include it in income. So debts forgiven doesn't mean that it's not going to be subjected to taxes. In addition, we have dividends. This is essentially when you have ownership in a corporation, they pay dividends. Employee bonuses, employee stock options, estates and trusts, farm income, fees, even if you have a gain from illegal activities. Uncle Sam says, hey, you know what? That also needs to be reported. Gains from the sale of property, gambling winnings, Hagi income, incentive awards, interest income, IRA distribution. So as we see, this list is exhaustive, right? And this is not all. There's more things. Again, there's more items that are included in gross income versus items that are excluded. So just keep that in mind. So if clients ever come to you with a question, hey, I'm receiving this amount of money, or I'm engaged in this activity, is it going to be taxable? For the most part, just about all income is taxable. But again, there are those specific provisions, as we'll see on the next slide. So some exclusions from gross income includes accident insurance proceeds, alimony. This is excluded after 2018 with changes to the Tax Cuts and Jobs Act. Annuities, as we see, it's to a limited extent. Bequests, casualty insurance proceeds, child support payments, any disability benefits, these are generally excluded. But again, based on a specific situation, they might be considered an income. It all depends. Federal income tax refunds are not considered taxable. Gifts, health insurance proceeds, inheritance, life insurance proceeds. So as we see, again, this is just a partial list. If you receive welfare payments, workers' compensation, there's a number of things that are not essentially considered income. And a key one here, we see scholarships, tuition, and books. So as it relates to scholarships, unfortunately, for room and board, if a portion of your scholarship accommodates your room and board, that would be considered income. So something to think about for those that, go to a college because of the scholarship. There is a potential that some of it would be recognized as income. Then we have Social Security benefits. We're going to learn that there are some limitations. So generally, if someone is retired and the major portion of their income is Social Security, if they have no other income, then for the most part, their Social Security is not going to be taxable. However, if they receive Social Security in addition to other income, the maximum Social Security benefits taxable is 85%, or it might be taxed at 50%. It ultimately depends on the taxpayer's situation. So salaries and wages, almost 80% of all individual income tax returns filed include some amount of wage income. So this would yield a W-2 at the end of the year. If you are an employee, you work for a company, the employer will send you a form W-2. Box 1 would report the taxable compensation, which are the taxable wages, the salary, bonuses, awards, commissions. These are all found on line 1 of the Form 1040 or the Form 1040-NR or 1040-SR. Box 2 would report the amount of federal income taxes that are withheld. Boxes 3 through 6, they report wages that are subjected to Social Security and Medicare. And then box 8 would report allocated tips. And box 10 would report any flexible spending contributions to a dependent care program. Next, we see box 12. This reports various forms of compensation, and it's identified by a code. Some of these items, they are just informational. They have no impact on the tax return. Like it would essentially show you the amount of health insurance provided by the employer or life insurance. These amounts are not taxable, but they show in box 12. In addition, in the event that You have elective deferrals into a retirement plan. You'll see it in box 12. Code V, income from non-statutory stock options, contributions to a health savings, cost of the employer-sponsored health coverage. Then box 13 will be checked if the employee is eligible to participate in a retirement plan. This is very important. The reason being is because for individuals that want to make a contribution to a retirement plan or an IRA, it's limited whether or not the amount on box 13 is checked. Box 14, that you would report other forms of compensation or deductions, and then boxes 15 through 20 would report state and local tax information. So you can see what it looks like. This is an example of a Form W-2. Sometimes instead of it being in this horizontal shape, sometimes it is more of a vertical shape, but for the most part, again, the numbers, the line items remain the same. So here you would start off with the employee's social security number, the EIN number, the employer's name and address, the control number. So one thing to keep in mind as it relates to those of you that want to venture into taxation, we live in this day and age where a lot of things are technologically driven. AI can prepare your tax return for the most part. So with that being said, let's say you utilize a program like TurboTax. TurboTax is going to ask you for the amount in box 1, and it's going to ask you for the amount in box D, the control number. And depending on the payroll processor, if it's let's say ADP or Paychex, if you input these two amounts, TurboTax is going to import your W-2 for you, and all of this information is going to pull in. Therefore, you don't necessarily need to input it. So here we see box 1, the wages and tips. Box 2 represents the federal income taxes withheld. Boxes 3 through 6, we see the Social Security wages and the Medicare wages. We know that for all income we earn, 6.2% is subjected to Social Security tax, and 0.45% is subjected to, or 1.45% rather, is subjected to Medicare tax. So 6.2 Social Security, 1.45 Medicare taxes. Lines 7, 8, and 10, these are input depending on your situation. 10 would be, as mentioned, for dependent care benefits. Boxes 12 would be other information. 11, non-qualified. So essentially, this is what a W-2 would look like, and depending on the state, that information would be completed. If you are someone like myself, I live not just in New York, but I also live in New York City. So I'm subjected to local income taxes. But if I lived somewhere like maybe California, boxes 18, 19, and 20 more than likely won't be completed because I'm just subjected to state income taxes, not local income tax. So just wanted to show you a visualization of what the Form W-2 looks like. So salaries and wages, once you are an employee, you will expect to receive the Form W-2. Next, we have accident and health insurance. So taxpayers, they can include from their income, or exclude rather from their income, the total amount received for payment of medical care, the payment for loss of use of a member or function of the body. So these plans, essentially, they pay for the cost of medical care of the taxpayer and any dependents that are insured under that plan. So the taxpayer can pay all of the premiums, or maybe their employer covers part or all of the premiums. So taxpayers, they're allowed this exclusion for payments that's received from these accident and health plans. And generally, these plans, obviously, they can't be discriminatory towards the taxpayer. Hence, they can exclude the total amount received. Next, we have meals and lodging. So meals and lodging, these are provided by an employer, and they're generally excluded from income if the following tests are met. So I remember my time in corporate America. I used to work out in Connecticut. I live in Queens, New York. So there would be, especially during busy season, there would be times where I would get there maybe, 8 o'clock in the morning, and then we're working way late in the evening. For me to drive home, that would be a little unsafe. So in those cases, what they would essentially do, they would feed you, you use the company card, or they would buy a large dinner for everyone. And then they had a hotel down the block. So there were a few times where it's just like, okay, I'm tired. It doesn't make sense for me to go all the way back to Queens, for me to come back to Connecticut in the morning. They allowed me to have lodging down the block at the hotel close by. So it was excluded from income. It wasn't taxable. Meals are provided by the employer on the premises. So they gave us food. I basically ate it in my cubicle during the working hours because the employee must be available for emergency calls or is limited to short meal periods. So it wasn't an emergency, but you know, it's busy season. They want to get as much work done as possible. And the lodging is provided by the employer on premises and must be accepted as a requirement for the employment. So again, to compensate for staying late versus having to send me all the way back to Queens, driving, several miles, it was easier to just stay in the area. So that's not included in income. Next, we have what's called employee fringe benefits. So the tax law provides that all fringe benefits, they're included in the employee's gross income unless it's specifically excluded by law. So the primary types of fringe benefits that can be excluded, here we see one, we have what's called a flexible spending account, also referred to as FSAs. So this is a way in which an employer, they can provide qualified non-taxable benefits to employees is they use what's called a cafeteria plan. So a cafeteria plan, it's essentially a written plan that permits the employees to choose between two or more benefits that consist of cash or some qualified non-taxable benefit. So a popular form of this cafeteria plan is this flexible spending arrangement, or sometimes it's referred to as a flexible spending account. So with these FSAs, it essentially permits employees to contribute pre-tax money to a special account from their wages in order to pay for health care, dependent care, adoption expenses. And if all of the requirements are met, then in such case, the employee, they provide any receipts for the expenses, and the full amount of the expenses are going to be reimbursed and treated as a tax-free reduction in salary. So as you prepare to get a job, go into corporate America, these are some things to keep in mind so you can legally, again, tax avoidance is legally, and you can utilize some of these employee fringe benefits to be able to reduce your tax liability. So the dependent care flexible spending accounts, they allow up to $5,000 per year to cover the costs of caring for a dependent child or an older parent. Healthcare FSAs, they allow up to $3,200 in 2024 to be set aside to cover medical expenses and health insurance co-payments. So it can result in a significant tax saving for employees. Here's the thing. If you don't use it, you lose it. So if you essentially have any amounts that's still sitting in the account on December 31st, unfortunately, you do not get the benefit. It does not roll over. So this is something you also want to factor in before contributing these pre-tax monies. You may also exclude certain fringe benefits for income, such as transportation, commuting benefits. This is up to $315 per month. So qualified transportation benefits, they often apply to parking, but they can also apply to the use of a commuter highway vehicle. So if you use an employer operated van pool, or if you use mass transit, you use the LIRR, what's it called? The one from Grand Central, the Metro North, that if you use the MTA and things of that nature, that will qualify. Next, you have the Dependent Care Assistance Program. So under this Dependent Care Assistance Program, the employer can directly or indirectly up to $5,000 for dependent care allow the employee to work. But keep in mind, the amount that's excluded, it can't be more than the employee's earned income. Employer paid premiums for group term life insurance. So employers, they can pay up to $50,000 of group term life insurance for employees as a tax-free fringe benefit. But one of the key things is that as they provide the group term life insurance, they cannot favor officers, shareholders, or highly compensated personnel. So what that simply means is that it cannot just favor a select amount of employees. It should be non-discriminatory and applied to all employees. Next, we have education assistance plans. So sometimes, depending on the company you work for, they might help you pay for the cost of furthering your education. So employers, they may provide up to $5,250 of excludable annual tuition assistance under an educational assistance plan. So I know like some big four companies, some mid-sized firms, they also make this available to their employees. So with the education assistant plan, it requires the employer to have a written plan, and the educational assistance, it can be paid not just to a current employee, but this also applies to former employees as well. Next, if there's tuition reduction, no cost additional services and qualified employee discounts with exceptions. Like I no longer work at Price Waterhouse or KPMG, but I still have a login whereby, let's say I want to go to a Broadway show, or if I want to go to the movie theater, I have access to a website that gives me discounts on these items. So I still get some qualified discount, employee discounts. It's not taxable to me. Some working condition fringe benefits, they're excludable only if the taxpayer can deduct the items on their own as an employee. Then we have some de minimis fringe benefits. So these are small benefits that would essentially be impractical to account for. So example, Monroe, what they generally do during Thanksgiving time is they'll give you a pie, right? You can choose between an apple pie, sweet potato pie, um, whatever other, whatever other flavored pies they have. It would be impractical to account for this, right? So these de minimis fringe benefits, imagine on my W-2, they're charging me an extra $10 or $15 for the pie. I don't want the pie in that case, okay? So that would be an example of a de minimis fringe benefit. The value of the use of on-site athletic facilities. So depending on where you work, my younger sister, she works at a bank, and at the bank in the basement, they essentially have a gym. It's not taxable to her. That's an employee fringe benefit. Retirement planning services are also considered a fringe benefit and may be excluded, obviously, depending on the situation. Next, we move on to prizes and awards. So prizes and awards, they are considered taxable income to the recipient. So, the game shows like Wheel of Fortune, what's the one with Steve Harvey? Whose line is it anyway? Family Feud, all these different things. Even in the mail, I just received something from 105.1 and Z100. They're like, hey, call in at the specific time, and if you were the caller, you'll get money. That's considered taxable, okay? Uncle Sam was like, hey, you know what? That's money. It's going to be subjected to taxes. So just keep that in mind. So winnings from television, radio shows, door prizes, lotteries, they are considered taxable. The taxable amount is equal to cash amount or the fair market value of the property. There is an exception. Employee awards of tangible personal property received for recognition of the length of service or a safety achievement award are considered excludable. So the maximum amount that's excludable will be $400 or $1,600 if it is a qualified award plan. So again, if it's an award received for an accomplishment, and it could be in a religious, charitable, scientific, artistic, educational, if it's in one of these fields, so let's say if someone wins the Nobel Peace Prize or the Pulitzer Prize, that's excludable. In addition, if it's a medal or prize for the Olympic or Paralympic athletes by the U.S. Olympic Committee, then they are also essentially excluded. So here we have this example, and it says, Jose, an employee of Vesuvius Statutories LLC, received a clock for 20 years of service. The clock is valued at $500. The award is not considered a qualified plan award. So in such case, the problem is asking us, well, how much if this is going to be includable? In such case, it's the $400 because it says the maximum amount excludable is $400. But if it was a part of a qualified plan award, in such case, the maximum exclusion would be increased to $600. But because the award is not considered a qualified plan award, of this $1,500 value, only $400 is excluded for Jose. Next, we move on to annuities. An annuity is an investment that taxpayers, they buy usually at retirement in return for periodic payments for the remainder of their life or for a fixed number of years. So the amount of each periodic payment is going to be based on a few things. It's based on the annuity purchase price, the life expectancy of the annuitant, and the life of the annuity contract. So there's some simplified methods to be able to determine how much is going to be taxable. So individual taxpayers, generally, they need to use the simplified method to calculate the taxable amount starting after November 18th, 1996. And the general rule is as follows. So prior to the simplified method, they use the general rule. So taxpayers, they would need to calculate the amount to exclude from income by using the following equation. So we have the amount excluded would be equal to the investment in contract, which would be our numerator, the annual payment, multiplied by our life expectancy, which would be in our denominator. And once we determine this amount, we multiply it by the amount that is received. So whenever it's a non-qualified plan annuity, in certain annuitants that are age 75 or older, they still need to use this general rule that is below. So it's either they're going to use the simple method or they are going to use the general method. And again, it ultimately depends on the situation. So as it relates to reporting the annuities, both annuities and pensions, they're reported to taxpayers on Form 1099-R. So Form 1099-R, that essentially you're reporting what is the amount of the 1099-R received. And then on box 2, it essentially lets you know how much is going to be subjected to tax. So depending on the individual, sometimes the amount in box 1 might be different from the amount in box 2. It ultimately depends, especially when you are, dealing with situations where maybe it was a Roth and things of that nature. So there might be differences. So you want to keep that in mind. So just to show you, this is what the Form 1099-R looks like. So here we see distributions from pensions, annuities, retirement, or profit-sharing plans, IRAs, and insurance contracts. It'll let you know what year it's for. Here we have the form number 1099-R. We have the payer's name, the payer's TIN. Then we have the recipient, the taxpayer's name, their TIN, their social security number, or their ITIN, their address, etc. And then we see these variations of box numbers. Box 1 would be the gross distribution, and box 2A will be the taxable amount. Sometimes you'll receive a 1099-R and there will be an amount in box 1, but you'll see that 2B is checked. So they don't necessarily know what the taxable amount is. So you would now need to work with your client to determine what the taxable amount is. Then if there's capital gains, that will be on box 3, because we know capital gains are treated at preferential tax rates, either 0, 15, or 20%. So that's separated for if there's any federal income taxes withheld. And then we have a lot of other boxes, employee contributions, if it's a Roth, any net unrealized appreciation in employer securities, the distribution code. This will let you know if it is a normal distribution, if it is an early distribution, which is subjected to a penalty. This checkbox, if it's an IRA, SEP simple, then if there's any state information. So there's a lot of information that can be reported on this form. And again, it's different for each client, but you want to ensure that as you are preparing a tax return, that you go through each line item to ensure that you are not missing anything. Next, exclusion for public safety officer. So any retired public safety officers, they can elect to exclude up to $3,000 from plan distributions to use it for paying premiums of accident, health, or long-term care coverage for themselves or for dependents. And here we have an example. It says Dontrell has saved $750,000 in his retirement account and uses it to purchase an annuity. His annuity equals $4,800 per month, and the standard mortality table shows that he is expected to live 19 years. Wow, how morbid. But how much of Dontrell's retirement is excludable from tax each year? And again, this morbidity table is just an estimate. Dontrell might live for 50 years, 30 years, right? Really all, So it might be correct, might be wrong. Maybe he'll live for 7. Who knows? But this morbidity table, again, expects to live for 19 years. How much of his retirement income is excludable from the tax year? And we're going to assume that Dontrell is required to use the general rule. So based on this, we're going to use the general rule formula as follows. So the investment in the contract, the problem lets us know, is $750,000. The annual payment is $4,800, but this is per month. So 4,800 times 12 is something we need to factor in. And we multiply it by the 19 years. So based on that, we get 0.685. So based on that, we factor in the amount received, the 0.685, multiply by the 4,800 times 12 months. Dontrell gets an exclusion of $39,456 worth of an annual exclusion each year. So the annual payment times the life expectancy multiplied by the amount received, that is how we calculate the annual exclusion in Dontrell's case. Next, we move on to life insurance. So a major exclusion from gross income is life insurance proceeds. And in order to be excluded, the proceeds, they need to be paid to the beneficiary by the reason of death of the insured. So if the proceeds, however, if they're taken over several years instead of a lump sum, in such case, the insurance company, they're going to pay interest on the unpaid proceeds, and that interest is generally going to be considered taxable. So here we have this example, and it says, Karina dies on June 15th, 2019, and leaves Daniel, her husband, a $500,000 life insurance policy, the proceeds of which he elects to receive as $100,000 per year, plus interest for 5 years. In the current year, Daniel receives $105,000. $105,000, well, $100,000, the principal, plus $5,000 interest. How much is taxable to Daniel in the current year? Daniel is going to be subjected to $5,000 worth of taxes. So this is a typo. It should be $100,000. So he only needs to pay taxes on the $5,000. If there's early payments of life insurance, and this is also known as an accelerated death benefit or a viatical settlement, then they're excludable from gross income. One, when, let's say, the individual is terminally ill or they're chronically ill, they collect an early payout from the insurance company, or the terminally ill or chronically ill taxpayer sells or assigns the policy to a viatical settlement provider. And in such case, all or part of the proceeds of the policy transferred for the value may be taxable. So when this transfer of value occurs, the proceeds at the death of the insured are taxable to the extent that they exceed the cash surrender value of the policy and at the time that it was transferred, plus the amount of the insurance premiums paid by the purchaser. So again, whenever there's these early payouts of life insurance, then in such case, it ultimately depends. A portion of it may or may not be subjected to tax. So we have this example here. It says Brianna transfers to Zima an insurance policy with a face value of $25,000 and a cash surrender value of $4,000 for the cancellation of debt owed to Zima. Zima continues to make payments, and after 3 years, Zima has paid $1,500 in premiums. Brianna dies and Zima collects $25,000. How much must Zima include in her gross income? And would this answer differ if Zima and Brianna were partners in a partnership? If so, how? And just keep in mind, whenever there's a sale or transfer of an insurance policy, there'll be 2 reporting forms. The acquirer of the life insurance policy, they're going to need to file what's called Form 1099 LS. And then the insurance company that has issued the policy, they're going to be required to file what's called Form 1099 SB. So based on the fact pattern, Zima's going to need to include $19,500 in her gross income. How do we calculate this amount? We start off with the face amount. So let's say Brianna died Whoever her beneficiary was, they would have received $25,000. None of it would have been subjected to taxes. However, in this case, Brianna transferred the amount. So the face value is $25,000. We subtract the cash surrender value of $4,000, and then we subtract the amount of premiums that Zima paid, $1,500. So therefore, $19,500 is going to be subjected to taxes for Zima. In the event that, let's say, Zima and Brianna were partners in a partnership, the entire $25,000 would be considered tax-free. So obviously, depending on the situation, it might or might not be taxable. Next, we move on to our interest income. So interest income can happen in a number of ways, right? One of the ways is that, let's say you lend money to a corporation, the corporation issues bonds, you receive interest income. You'll receive the interest for lending money to the corporation. It can also be, let's say you open a account with a bank, especially now banks, they have lots of different incentives. You move your money, you open a bank account with this new bank, and they say, hey, if you deposit $5,000 within the first 3 months, then we'll give you $600 in interest, or, the amounts vary, but the bank is willing to pay you interest for keeping your money in the bank account. And if you really think about it, what the banks do, they lend out our money and they make more interest on it, right? Pretty much. So, but when it comes to interest income, the total interest income that's greater than $1,500, it's going to be reported on Schedule B. The fair market value of gifts or services a taxpayer receives from making long-term deposits or opening an account is taxable interest income. So when you receive that, notice in the mail where it's like, hey, come to this bank. Like, I receive them all the time. They're like, hey, come to this bank, deposit the money. They'll have it in very large font, very large, letters and numbers, how much you'll receive. But they have it in very, very small letters that you're going to receive a 1099 INT. So you just want to keep that in mind. Uncle Sam still is going to require you to report it. So interest is reported in the year that it's received by a cash basis taxpayer. The U.S. savings bond, we have called Series EE bonds. And these are purchased at a discount before 2012 or at face value. And they essentially increase in value over time. So the U.S. government, they issued 3 basic types of savings bonds to individuals. We have Series 1 bonds, Series EE bonds, and Series HH bonds, essentially. So with our Series EE bonds, these are essentially, whether they're sold at a discount, they increase in value, as we see, over their life at a fixed rate of interest for the first 20 years of the bond's life. And as of 2023, they were paying about 2.5%, which is much better than a lot of the banks. Then we have these Series HH bonds. So with these Series HH bonds, the last time that they were issued was in August of 2004. And they have a 20-year maturity. And these HH bonds, they were issued at face value and they pay interest twice a year, semi-annually. And any interest received on these bonds, they're going to be reported. And the Series I bonds, these can be purchased directly up to $10,000 per person, or they can be purchased through an income tax return for up to $5,000. Essentially, they're issued with a fixed interest rate, and they essentially, like, the interest, it adjusts each year for inflation, and it's paid semi-annually twice a year. Bond interest is the interest on the U.S. government bonds, and it is subjected to federal income tax, but it is exempt from state income taxes. So that's something important to keep in mind. Corporate bonds, generally, they'll pay interest every 6 months, semi-annually. And interest from any municipal bonds is considered tax-free. And the after-tax return for a tax-free bond is calculated as follows. So it'll be the tax-free return divided by 1 minus the tax rate. And interest rates on municipal bonds, generally, they'll reflect the after-tax return, and that essentially compensates any high-income taxpayers. So here we have this quick example. It says Faisal is in a 32% federal income tax bracket and invests in a Nashville city bond paying 6%. what taxable interest rate will yield the same after-tax return as the municipal bond? So based on this, the tax-free return, it lets us know, is 6% divided by 1 minus the tax rate. He's in the 32% bracket. So 1 minus 32, I believe that would give us 68. So 0.06 divided by 0.68. The yield that would return the same after tax would be an 8.82% municipal bond. And if there's a below market loan, individuals, they may make small loans to each other below the market rate. As it relates to reporting interest income, generally interest income that's greater than $10, it needs to be reported by the payer on Form 1099 INT. Taxable interest, again, if it is more than $1,500, then a Schedule B will generate. If it is not more than $1,500, then it would just be on the face of the Form 1040. Any tax-exempt interest income, although it's not taxable, it is reported on line 2A of Form 1040. Next, we move on to dividend income. So dividend income, this is essentially where you have ownership in a corporation, and through ownership in that corporation, the corporation issues dividends. So dividends, they're essentially a type of distribution that's paid to shareholders by a corporation. And taxpayers, they can receive the following types of distributions from a corporation: mutual fund, or similar investments that own corporate stocks. They can get ordinary and qualified distributions. They can receive non-taxable distributions, or they can receive capital gain distributions. So ordinary dividends, they're the most common type of corporate distribution, and they're essentially paid from the earnings and the profits of a corporation. And then if they are treated as qualifying dividends, if they're held for a certain amount of time, and one of the benefits of a qualifying dividend is that it's taxed at a preferential rate. So corporations that issue the dividends and brokerage firms holding stock, they're required to classify and to report the amount of qualifying dividends. Again, because ordinary dividends are taxed at ordinary rates, qualifying dividends are taxed at the preferential tax rates of 0, 15, and 20%. Next, when we're dealing with non-taxable distributions, they're not paid from a corporation's earnings and profits. They are essentially a return of the taxpayer's original investment. So it's not subjected to tax, but anything in excess of that would be. It's not included in the taxpayer's income, but it does reduce the taxpayer's basis in the stock. Then we have capital gain distributions. So whenever the stock reaches a zero basis, anything in excess of that is going to be treated as a capital gain, subjected to the preferential rate if it's long-term, or ordinary rates if it is a short-term. And these will be reported on line 7 of Form 1040 or Schedule D of Form 1040. So this you'll learn more about in corporate income taxation, where you learn about corporate distributions. But for those of you, again, that want to venture into taxation, you'll see these 1099 DIVs, and you'll see the various amounts that are reported on the line items, and you'll get a understanding, essentially, as you go through corporate taxation, and you'll understand how these amounts come about. The current tax rate for dividends, as we know, qualified dividends are taxed at the preferential rates, either 0, 15, and 20%. And depending on the situation, when we are dealing with high net worth clients, unfortunately, they are subjected to the NIT tax, the net investment income tax. So they can be subjected to an additional 3.8%. These rates are lower than the rates for ordinary income, and we have a table on the next slide. So this is essentially how you would determine how much is going to be subjected to income. So depending on your income level and depending on your filing status, that lets you know what the rate is going to be for qualified dividends and long term. So if we're looking at married filing joint, if their income is between $0 and $94,050, none of their qualified dividends or capital gains is going to be subjected to any taxes. If they fall within the range of 94,051 to 583,750, it's taxed at 15%. So you essentially do the same thing for the various filing statuses. Single, the maximum amount for it to not be taxed at all is 47,025. Head of household, 63,000, and married filing separate, 47,025. So as we see, there are some differences between the filing status and the income level, and that determines if the qualified dividends and long-term capital gains are going to be subjected to 0, 15, or 20%. It is mentioned with the dividend income, it'll be reported on Form 1099 DIV if it's greater than $10. If it's more than $1,500 in total, then it would be reported on Schedule B. If it is less than $1,500, it would just be reported on the face of the Form 1040. Any capital gains and dividends, those would be reported on Schedule D of the Form 1040. Next, we move on to gifts and inheritances. So inheritances, they are excluded from income, and any income received from property after the transfer is considered taxable. So normally the gift tax or the estate tax, it would essentially be paid by the donor or the decedent's estate, and usually it'll be tax-free to the person that's essentially receiving it. One of the issues though with gift tax is they, have an issue with determining what actually is a gift. So the courts, they essentially define a gift as a voluntary transfer of property without any adequate consideration, right? So like I found myself in a situation where I had to, ask a friend to borrow some money, and she decided, well, that's just her take. She doesn't believe in lending money. So she lent me the lump sum of money. It's not, included in my income. It's not considered taxable income. And for her, because it was below the threshold, she doesn't need to report anything. When it comes to gift taxes, the maximum amount is $18,000 once you give an amount, and that adjusts each year. But for 2024, the maximum amount is $18,000. Anything in excess of that, then you would need to file a gift tax return. But it's the individual giving the gift that needs to file it, not the person receiving it. Next, we move on to scholarships. The scholarship is an amount paid or awarded to for the benefit of a student to essentially pursue higher education, right? So college, going to get your associates, your bachelor's, your master's, etc. So the key thing is it relates to scholarships. So scholarships, they're granted to degree candidates, and they're taxable income with the exception of any amount spent for tuition, fees, books, and any course required supplies and equipment. Those are considered excluded from income. So as mentioned, room and board, unfortunately, it's going to be included in income, or any amounts received as compensation for required work. So let's say, you're working at the college and you are doing work study, those amounts would essentially be considered income. So that's something to keep in mind. Next, we move on to alimony. So with alimony, there were some changes essentially with the Tax Cuts and Jobs Act. So in order to be considered alimony payments, they need to meet these requirements. The payment needs to be in cash, must be received by the ex-spouse. The payments must be made under a decree of divorce or separate maintenance, or under a written instrument that's incident to divorce. They can't continue after the death of the spouse. They can't be designated as anything other than alimony, so it can't be child support or anything of that nature. And if the parties are divorced or legally separate, they cannot be members of the same household when the payments are being made. And when you're dealing with property transfers, in the event that, let's say, there's a spouse that transfers property in a settlement of a marital obligation, they're not required to recognize any gain as a result of the property's appreciation. And child support. Child support is not deductible by the payer, and it is not taxable income to the recipient. But it is an important factor when it comes to determining which spouse gets the dependency exemption for the child in question. Next, we move on to some educational incentives. So we have what's called these QTPs, qualified tuition programs, and these essentially allow taxpayers to meet the qualified higher education expenses by either they can buy in kind tuition credits or certificates, they can contribute to an established savings types account, and depending on the state you live in, some states they essentially give you a incentive, like you can claim a deduction on your tax return for investing into a 529 plan. Like I live in New York, and they allow you to claim a deduction for the amount that you are contributing to one of these 529 plans. So distributions, they're considered tax-free, obviously, if they're used for qualified higher education expenses, such as tuition and fees, books, supplies, equipment. Reasonable room and board costs, obviously, is subjected to certain limitations. But if you invest into these QTPs, then you are allowed to essentially make the distribution to these, or make the distributions from these qualified plans, and it is tax free. As it relates to qualified higher education expenses, this also includes any tuition in connection with the enrollment or attendance at an elementary or secondary, public, private, it could even be a religious school. Annual contributions amounts, they vary and they're considered gifts, thus they are subjected to the gift tax rules. And in such case, taxpayers, they can claim the American Opportunity Credit or the Lifetime Learning Credit in the same year that the distribution is taken on behalf of the same student. A key thing is that the distribution, it can't be used for the same expenses for which the credit was claimed, and it needs to also reduce the qualified higher education expenses that are excluded from income by scholarships, veterans benefits, etc. And any amounts that's held in a Section 529 plan, the good thing is that it can be rolled over to a Roth IRA of the same beneficiary and excluded from gross income if the account was open and in the beneficiary's name for at least 15 years. The amounts have been held in that 529 plan for at least 5 years, and the rollover amount, it doesn't exceed the amount contributed during the previous 5 years. But keep in mind, there is a lifetime limit of $35,000 for the designated beneficiary. So for someone who essentially has their child in like a private school, because again, this applies to K through 12, and it also applies to higher education as well. And then some educational savings accounts. Taxpayers, they're allowed to set up these educational savings accounts to pay for the qualified education expenses, and the contributions, they're subjected to income limits. $2,000 per beneficiary per year. They're not deductible. Can't be made once the beneficiary reaches 18. It can't be made in the same year as the contribution to the beneficiary, and depending on your adjusted gross income, it might essentially phase out. So that is something to keep in mind. And then lastly, is just talking about the distributions. As we mentioned, they are tax-free if they're used for qualified education expenses for college, private, elementary, and secondary schools. Qualified education expenses, these includes any tuition and fees, any books, supplies, and equipment, any room and board for at least 50% of the full-time course load. And in the event that the distributions received exceed the qualified education expenses, the excess is going to be treated as a return of capital and distribution of earnings. Next, we move on to unemployment compensation. So with the unemployment compensation, this is essentially you were working a job, you lost a job, you receive unemployment. So unemployment compensations, they are generally fully taxable, and they would be reported on a Form 1099-G. There was a special rule during COVID where, depending on your situation, up to $10,000 was not considered taxable, but it depends on the state you lived in. Like I'm from New York, and New York did not agree to this federal provision. So therefore, for all individuals that received unemployment compensation for federal purposes, $10,000, I can't remember the exact amount, but it was around 10,000, $10,000 was deducted, but when you prepared your state tax return, New York would add it back. So some states, they were in alignment with the federal provision and didn't include the unemployment compensation for the deductible amount, but states like New York, they added back the amount. Next, we move on to Social Security. So Social Security benefits. Some taxpayers, they can essentially exclude some or all, and it ultimately all depends. So the maximum inclusion amount is 85%. And the inclusion is ultimately based on the taxpayer's modified AGI. So right now, we're essentially just looking at the theory behind Social Security benefits. But once you get the opportunity to essentially look at some problems, then it'll start to make more sense to understand, hey, is this taxpayer going to be subjected to 50%, 85%, or is none of the Social Security benefits going to be taxable? So it ultimately all depends. So the base amounts are as follows. So the amount that applies to married filing joint is $32,000. If you are filing a married filing separate return, unfortunately, if you earn more than $0, then a portion of your Social Security is going to be subjected to taxation. For all of the taxpayers other than married filing joint or married filing separate, once their income is over $25,000, then in such case, a portion of it is going to be subjected to taxes. So we call that the provisional income. There's a special calculation that goes into determining the Social Security benefits. Generally, the tax software, it'll calculate and let you know the taxable amount. But from a perspective of tax planning with a client, you want to be able to educate and empower them to know, hey, in the event that, let's say it's a retired individual and they want to get an extra job, you want to let them know, hey, once you start to make over XYZ, just so you know, a portion of your Social Security income is going to be subjected to taxes. So something important to keep in mind. Next, we move on to community property. This is essentially for individuals that live in certain states. Whenever their married couples file a separate income tax return, there's a problem. There's an issue, right? Because income that's derived from property that's held by a couple that is married, whether it's jointly or separately, this also includes their wages and other income. It needs to be allocated between the spouses. So this is at a state level. This does not apply at the federal level, but this is the law in 9 states that follow what's called the community property system of marital law. So in these states, the property rights of married couples, they essentially differ from the property rights of married couples in common law states. So New York is a common law state, but the 9 states that are community property is Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And in Alaska, spouses, they can decide to treat their income as community property. So under this community property, simply stated, all property is deemed to either be separate property or it's deemed to be community property. And separate property, this essentially includes any property that was acquired by the spouse before marriage or received after the marriage, but it was a gift or it was an inheritance. And under these community property states, what that means is that all other property, all other income that's owned or earned by a married couple is presumed to be community property. So what that simply means is that each spouse is automatically taxed on half of the income from community property. So we live in this day and age a lot of times where persons that want to relocate to a state for various reasons. If you are married, it is very, very important to confirm whether or not where you are relocating to, if it is a community property state or if it is a common law state, because this is a special problem that arises when a married couple wants to file a separate tax return. And again, this is on a state level. So when the spouses live apart, the married spouses residing in a community property state, they don't live together. The tax law contains an exception to the community property rules, and under the special provision, spouses, they'll be taxed only on their actual earnings from personal services when the following conditions apply. The individuals, they have to live apart for the entire year. So it's not, they weren't together for the last 6 months of the year. No, they need to be apart for the entire year. They cannot file a joint return, and no portion of the earned income can be transferred between the spouses. So you can't Zelle the spouse any money. You can't help them pay any bills. No, there's no portion of the earned income that can be transferred between the spouses. So obviously there's a bit of nuance. There's some specific rules that need to be met. And lastly, we look at the cancellation of debt income. So cancellation of debt income, this is an economic benefit to the person receiving the debt relief. But as mentioned, if you have a credit card and the debt was $10,000 and it went to collections and they say, hey, if you pay $5,000, we'll wipe out the debt. Great. You don't have to pay the other $5,000, but what you do need to do is consider it income. You'll receive a Form 1099-C for the $5,000 and you would need to report it in income. So the amount forgiven is considered income with the following exclusions. If the taxpayer is bankrupt or insolvent at the time the debt is canceled or reduced, if the debt is qualified real property business debt, if the debt is qualified principal residence debt, or if the debt is a certain type of student loan that is forgiven under certain situations, in such case, then it would not be considered taxable income. So this brings us to the end of chapter 2, gross income and exclusions. So now that the chapter has ended, you should know how to apply the definition of gross income. As we mentioned, gross income is essentially income from whatever source derived. So as a U.S. citizen, it doesn't matter where the income is earned. It can be international. The key thing is it was earned, and it will be reported as income unless there's a specific inclusion in the tax law. We described salaries and wages, income reporting and inclusion. We learned about the W-2, and we also learned about some employee fringe benefits that are excluded. We looked at the general tax treatment of health insurance, determining when meals and lodging may be excluded from taxable income. We identified some of the common employee fringe benefit income exclusions. We determined when prizes and awards are included in income, and for the most part, they generally are included, with the exception of employee service recognition awards, and depending on the type of award, either $400 might be excluded or $1,600. We also calculated the taxable and non-taxable portion of annuity payments. We have the simplified method and the general rule, and depending on the facts and circumstances, you would use either of the two. We described the tax treatment of life insurance proceeds. If you receive the lump sum, is generally not taxable, but if you receive periodic payments, the interest is subjected to taxes. We identified the tax treatment of interest income reported on 1099 INT, the tax treatment of dividend income reported on 1099 DIV, the general rules for the tax treatment of gifts and inheritance, the elements of scholarship income that's excluded for tax. So long as the scholarship is for tuition, in books, and other qualified expenses related to tuition, it is excludable. However, room and board, unfortunately, is considered taxable. We describe the tax treatment of alimony and child support, the tax implications of using educational savings vehicles, the tax treatment of unemployment compensation, the rules that govern the inclusion of Social Security benefits. So it's either Social Security benefits are not taxable at all, subjected to 50%, or subjected to the maximum of 85%. We distinguish between the different rules for married taxpayers residing in community property states when they file separate returns. And as mentioned, there are 9 states that follow community property rules. All other states are considered common law states. And lastly, we describe the inclusion and exclusion of cancellation of debt income. So this brings us to the end of Chapter 2, Gross Income and Exclusions.